And for more on the Dis-Chem results, as mentioned, we are joined by the CFO and the man who will take over the reins from the outgoing current CEO, the founder, Saltzman, and that is Rui Morais. Rui, thank you very much for your time this afternoon. You've been with the company since 2010 and are now set to become, if I'm not mistaken, correct me if I'm wrong, the youngest CEO on the JSE, a JSE-listed company. How does it feel to actually take over from a man who has had 45 years at the helm? I'm sure you've learned a lot from him.
Yes, afternoon, Xolani. It is an exciting time for me personally. As you said, I've been working with Ivan for the last 13 years, and in that time, I've really understood the philosophy that's entrenched and what makes the brand different. So this view on value and service, and ultimately holding the patient or customer at the center of what you do. So I've learned a lot. I myself am a CEO by trade, but I feel more and more like a pharmacist. I've been working very closely with the pharmacy part of our business. So, yeah, it's a challenging time that I find myself in, and that the group finds itself in with a constrained consumer. But at the same time, I guess it depends on how you look at a challenge. Within challenges lies opportunity, and I'm looking forward to the challenge and very excited about the prospects of the group.
Rui, I wanted to ask you a bit more about that consumer financial and household financial constraints a little bit later. I wanted to know right now what is in your in-tray when you take over the reins in July. What are going to be the major issues that you're going to be contending with as the new CEO in 3 months' time?
So I think we have an environment where operating costs are rising. We spoke about it. The reality is that the investment in diesel cost is required, and we have to be honest with the fact that that's going to continue over the next 12, 18 months, and it becomes a new cost line that we have to deal with. At the same time, we have pressure on the top line as a function of that constrained consumer, even in very resilient markets like the retail pharmacy market. So, that tension, which ultimately potentially plays out in negative operating leverage, is something that we're going to have to watch closely. But certainly from our perspective, it's really crucial for us to establish ourselves as kind of South Africa's healthcare authority. We speak a lot about our ambitions to develop a healthcare ecosystem, and we've recently launched our Dis-Chem health insurance product or medical insurance product, and the intention there is just to ensure that we can offer care, and specifically in that space, day-to-day care at a much lower cost. We've said that there's about 12 million employed people who are uninsured. These people are consuming health care at a very expensive price point as a function of not being part of a medical aid. And it's important for us to try and lower the cost of care, and in doing that, obviously drive that foot traffic and those individuals into our stores. So that's our greater long-term ambition.
Let's talk about the load-shedding situation. We've heard from other retailers in the food space, and that would be ShopRite and many others, spending R500 million in a space of exactly 1 year to run generators. You spent R91 million in the past year to run generators and keep the stores open. How difficult does it, make for you as management to expand when it comes to operations and the new store footprint that you want to actually see that through, with load shedding being hanging over you rather for such a long time?
Sure. So I think from an infrastructure perspective, we've always rolled out generators into our stores historically, and we'll continue to do that as we think about space growth. We obviously intend rolling out space. We obviously intend step changing the space growth profile of our group. It's still an attractive market with respect to the fact that we're not very represented in some of the other main metros. We're quite well represented in Gauteng, but certainly from a Western Cape and a KZN perspective, there's opportunity there. So it doesn't change our approach to rolling out space. It just is another operational cost that you have to manage. But it certainly doesn't change our ambitions longer term, and it's just one of the headwinds that, I guess, managing in a business within South Africa, that it comes with.
Let's talk about the economic situation in South Africa for households. As we spoke briefly about it, we are expecting interest rates to rise next Thursday when the MPC announces its decision. There's a lot of expectation that has already been priced in that by the market that there's going to be at least 25 basis points or 50 basis points. And also, when you look at the rand weakening in the past week, the operating environment in South Africa is a difficult one. For the outlook for the company, what does that mean?
So very difficult. I mean, you've kind of nailed each of the things that kind of make us worried. I mean, exchange rate weakness, whether it influences on the direct imports or whether it catches us on indirect import supply, where agencies exist in South Africa. That's something ultimately that you either have to absorb in your margin line or pass on to consumers. It's exactly that same consumer that's under pressure. So, you need to try and find or create value in the wallets of clients. Again, it talks to our ambitions to kind of, develop a healthcare ecosystem which allows consumers to access healthcare in our space at a lower price point. If we're able and successful in doing that, we'd naturally kind of move a whole bunch of consumers into our space, and those volumes would compensate for some of the challenges that you've just spoken about.
Rui, thank you very much for your time this particular afternoon, and congratulations on your promotion. Rui Morais, the current CFO at Dis-Chem, he is now the CEO-designate, taking over the reins from Ivan Saltzman from the 1st of July this year. Of course, this is one of the companies that is finding it tough to operate in South Africa with the advent of load shedding, and it's in the final stages of agreeing to acquire a 63,000 square meter distribution center for R500 million in Gauteng, and the load shedding crisis is making it more difficult for operations, just like most of the retailers. Well,